Bank of Canada decision is imminent. We've got two heavy hitters joining us right now. Ed Devlin, founder of Devlin Capital, senior fellow at the C.T. Howe Institute, former head of Canadian portfolio management at PIMCO, and Warren Lovely, chief rate strategist at National Bank of Canada. Guys, thanks very much indeed for joining us. Warren, just very quickly, if I could, you are expecting a rate cut that would bring the Bank of Canada right into the middle of neutral rate territory.
That's right, us, and I think pretty much everyone, Ed, probably as well. So it'd be the right call, given the amount of uncertainty we have. I guess to some extent you could call it a bit of an insurance move at this juncture, but we're facing, I think, an existential threat to the Canadian economy, and moving a little bit lower into neutral is just the right move at this time.
Even though Tiff Macklem did indicate, Ed, a while ago, you know, monetary policy is not that suitable a tactic or a tool when you're dealing with a tariff war.
Exactly. But that, yeah, so what'll be interesting to see today is, you know, what role the Bank of Canada thinks they're going to be in playing this Team Canada, you know, response to the tariffs. You know, I think that'll be the kind of the interesting thing to watch today.
It's they're strange times, aren't they? The Commerce Secretary, Howard Lutnick, south of the border, saying Canada needs to integrate with the US.
Haven't we already?
Yes,
Really?
Good point. Okay, so we are getting the decision from the Bank of Canada right now. And there is the Canadian dollar. And the Bank of Canada is cutting rates, bringing it down as expected. The dogs in the street were barking this, 25 basis points, bringing the core rate to 2.75%. Warren, no great surprise, but we haven't read the commentary.
Right, no real surprise, and I think Ed's already touched on it. It'll be interesting to hear what the governor and the senior deputy governor have to say in defending this. I think we all agree monetary policy, not a perfectly calibrated tool for a trade war. We know there's some inflation fears that come when we're in a beggar thy neighbor, you know, full-on retaliatory trade fight. So they're, I'm sure, mindful of that. But at the same time, we risk economic paralysis here. So not appropriate to be at 3%. I guess the real question will be how far down do interest rates need to go in conjunction with what we fully expect will be a government fiscal policy reaction as well. I think it's going to be all hands on deck, to be frank.
That's interesting, yeah, because Ed, I think we've heard talk that it could be a COVID-style stimulus package for the economy.
Yeah, I'm not sure. I think it'll be hopefully better. I think Mark Carney has a better understanding of economics than Justin Trudeau does. So I think it'll probably be better. It'll be interesting now that you have, you know, a former Bank of Canada governor setting fiscal.
Yeah.
And the Bank of Canada. So, like, you know, I agree with you that, like, similar to COVID, there will be a coordination between the fiscal and the monetary agents. And, you know, how that works out, that'll be key. I think that's what I'm looking for today. You know, the balance sheet, what do they do with it? If nothing, do something. You know, it'll be interesting to see.
Oh, you mean, sorry, quantitative easing measures, maybe?
Correct. So what basically happened during COVID was, you know, the massive amount of fiscal spending to support, you know, vulnerable people, and the Bank of Canada said, we'll fund it for you. You issue them, we'll buy them, right, kind of thing. So do we have something similar to that? I've been a big advocate, and the central banks hate it, and they're not probably going to do it, but they should. They just won't. Is they should be engaging their balance sheet before they get to the zero lower bound. Right, because normally the order of operations is get the interest rates as low as they can go, and when that bullet has been spent, then they turn around and use the balance sheet, right? And I think that is probably, I think when you get to the zero lower bound, bad things happen. There's unintended negative consequences that happen. So it's probably better to do that before you get to the zero lower bound. So if you have to engage the balance sheet, do it earlier. That is my suggestion or recommendation. It is not my forecaster.
Well, you mean bad things happen when you bring interest rates down drastically, such as asset bubbles? Exactly.
All kinds of, like, asset bubbles. You get things like, you know, the potential for more of a deflationary spiral, inability to handle shocks, because you can no longer cut anymore because you've already spent all your bullets. You know, so financial stability issues. There's lots of things that happen that are just nasty. You get, you know, ask the Bank of Japan, you know, kind of thing. So I think that it would be my recommendation. And, you know, these are unprecedented times. This trade war we've got with our closest friends and neighbors. So will they think outside the box? I don't know. I hope so.
Warren, is there a risk that if we do keep bringing down interest rates, that people will just start saying, well, the heck with it, I'll just bid up houses, I'll put my money into real estate, and we'll get into...
Well, theoretically, yeah, but you do need to see confidence. You do need buyers to have confidence in the economic outlook, their own job prospects. So this is where it's a little bit, it's a little bit more of a nuanced conversation, right? So at this juncture, the irony here is we had some signals that the Canadian economy was starting to show some signs of life in response to earlier interest rate cuts. We had seen some firming in GDP. Inflation had a little bit of a heartbeat to it below the surface. So on its own, if you could somehow suspend the tariff discussion, set aside geopolitics for just a brief moment, it's not so clear that we need drastically lower interest rates at this juncture, but you can't suspend it. We know that we face this threat. It's hard for Canadians to be confident in where the economy is going. It's hard for them to be confident in their own finances. And as a result, lowering interest rates, if we get some relief in mortgage interest rates, I'm not sure it's going to bring about this tidal wave of enthusiasm for housing markets and housing prices. So the fear of setting off some asset bubble here, I think, is it's really not a non-existent threat, to be frank.
That's interesting because, I mean, obviously, politically, it would be unpopular if affordability dropped off and governments are allegedly making it easier to buy a house.
Right. Well, I mean, I think the question is you make the right policy decision for that moment in time. And in an ideal world, you like to be forward-looking as well. And that's where I say, on a forward-looking basis, we've really lost a lot of confidence, I think, in the economic road ahead here in Canada. What business is going to be investing in the Canadian economy right now when you're not even certain you can access the United States, right? That you can integrate with in a North American context. So I think we're going to see business investment in the deep freeze. We're already starting to see some signs of weakness, paralysis, as I say, in the housing market. Confidence channels risk being broken here. So the right decision for today was to lower interest rates. I don't think we're done here. And Ed, I think you share this opinion as well. I mean, I think the debate is how low do we need to go on interest rates to improve our economic prospects and maybe encourage the economic transformation that, again, we all kind of agree we're probably going to need, particularly if access to the U.S. market is not going to be as reliable as we'd like it to be.
So, Ed, if the Bank of Canada goes on cutting rates, we're going to move towards negative real interest rates, I guess.
That's right, exactly. So, put it this way: if we, if they can get inflation down a bit to their target, and then, like I've kind of been saying, literally for a year or so, they're going to go to 2. And I still kind of hold that, and I think market right now is priced at 2.25. So it's largely been priced in now. There's no magic to 2, but 2 is a 0 real interest rate, right? Where you're just getting the rate of inflation on your cash, kind of thing. To me, that's the logical place to be. So yeah, but I think the more important thing is the central banks in general, Bank of Canada included, have this concept of what I call risk management. What is their left tail risk and what is their right tail risk? Where is there a skew kind of thing? And I would be very interested in hearing from the bank how they think of tariffs from a risk management perspective. Because if you think about it, it's probably likely that this is going to go on for all 4 years of Donald Trump. Do you think he's just going to say, "Oh, that's done, I'm out," right? I don't, kind of thing. And to Warren's point, we've permanently degraded the U.S. as our counterparty, as an economic counterparty. They've reneged on their deal, right? So logically, and Carney said this in his speech on Sunday, is time to diversify, time to move to other kinds of markets. So what does the Bank of Canada think its role is in that plan? And I think these would be the kind of really interesting things to hear from the bank on.
I mean, so we've got at least, our incoming Prime Minister saying we've got to diversify our exports. I mean, there's nothing new there. We've heard that for decades. Meanwhile, south of the border, they're saying, no, you've got to integrate.
More closely integrate. Yeah, I mean, I sympathize with policymakers, monetary and fiscal, at this juncture, because this is a really extraordinary amount of uncertainty that we're dealing with. It's not really clear. You don't necessarily get the same message, the same signal from U.S. administrators from day to day, right? So the playing field is kind of moving under our feet to some extent, which makes it very, very difficult. The type of sort of diversification and economic transformation that Ed is alluding to, I mean, to some extent, and I agree, I mean, you want to understand what the Bank of Canada views its role in that type of transformation. But I think it's also clear that political leaders, elected officials, prime ministers, and premiers have a major role to play here as well. And Ed touched on balance sheet from a central bank perspective, but think about the balance sheet from a government perspective. We're probably going to need to be using whatever balance sheet room that we created earlier as we retool the Canadian economy.
Big deficits then, or bigger deficits?
Well, arguably, yeah. I mean, and I don't think this is going to be unique to Canada, to be honest. I mean, we're seeing this in other jurisdictions. Look at what Germany's doing, right, in terms of a transformative investment in defense and infrastructure. We're going to need to take these types of probably extraordinary, what will look like in a historical context, extraordinary actions to set us up down the road. What you hope is that political leaders look through maybe an electoral cycle or two, make those big long-term structural decisions that we're going to need as Canadians, because the old rules don't apply. You know, the old rules of engagement are gone. I like the way Ed put this. I mean, the U.S. has reneged on the deal. I mean, I think that's the right way to think about it.
This reminds me of back in 2008 when I was trading derivatives with Bear Stearns and Lehman Brothers. You know, when you started to get bad news, you know, what's the thing you do? You remove your risk to the counterparty, right? Like, that's what you do. And, you know, we've got bad news from our trading counterparty. I'm going to remove, as much as I can, remove that risk. That's what any logical investor would do.
Let's dip in here. Sorry.